presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compac Market Wrap YouTube update for June the 2nd, 2025. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. First of all, don't forget to subscribe to this channel. All you have to do is click on the subscribe button, so whenever I post an update, you will be notified and you can watch it at your convenience. Looking at the numbers last week, great week in the markets. S&P up 1.9% for the week. For the quarter, we are up 5.57%. Year to date, now we're positive again. Dow gained 1.67% on the week. Another good week for the Dow, and the NASDAQ was up 2.02%. So this was number one. This was two. S&P, and the Dow was three. I like that configuration. I like to see the NASDAQ leading, S&P second, and the Dow third. When it goes in the other direction, that is usually not a good sign. Also, we saw emerging markets down. EFA was up 0.91. Russell growth was up 2.31. Value was up 1 point, and Russell 2000, the small cap, up 1.32% for the week. Looking at the best sector, interest rates backed off a little after the budget, the big beautiful tax bill as it is called, did not show as large a deficit as some were expecting. And that is usually a good sign for the market, as the interest rate said, well, the U.S. will not have to borrow as much. We'll see what happens in the Senate, which is going to start debating that big beautiful tax bill this month, and it is expected to be on President's desk by July 4th. We'll have to wait and see what changes come out in the Senate negotiation, and then it has to go back to the House, and they have to approve those changes also. So it's going to be a little messy. They're going to talk about, oh my God, it's failing, and then they're going to come around at the last minute and agree. That's usually how this process works. And if we do get that bill, I think it will be stimulative. It's going to help. It was supposed to show that there will be such big drastic cuts in federal government spending that it would slow down the economy. But now it looks like the government is going to increase spending between $2 and $3 trillion over the next 10 years. There'll be no more tax cuts, more money in people's pockets, and that's going to be stimulative for the economy. So I've talked about that for the last month or so, and everybody was focused on tariffs. I said tariffs are something of the past. The markets are going to adjust to it and realize that whatever tariffs comes out, they're not going to be as bad as Liberation Day the announcement was. The administration has backed off from a lot of the high tariffs, and negotiations are going on. Yes, we did get some more tariffs on steel and aluminum coming out this weekend, but I think that was just to prod the Europeans to come around and start negotiating in earnest, and that's what I believe is going to happen. Worst sector last week was energy. Looking at oil, it's at $61, so the president has some room to make some cuts in the energy spending, and that could help the inflation numbers. Treasury also down. That was what stimulated the real estate market a little bit, down from 4.51 to 4.41, which is good because as long as we stay between 4 and 4.5 or so, market can handle that. If we get above 4.5, heading towards 5% for the 10-year, that means interest rates are going up, and there's a concern for inflation with the economy slowing, or at least the expectation. We do get a lot of data this week, and I'll talk about that. So it's a big data week. We get the unemployment data for May on Friday, and that'll give us a picture. That is the biggest concern, the slowdown if we do get a slowdown in hiring. Last week we got a good number. You can see that for the last 30 years or so, 35 years or so, the average home buyer was between 31 and 33 years old, the first-time buyer. You can see it is becoming more and more difficult for first-time buyers. Since 2020, now we're looking at close to 38 years of age for the first-time buyer. So it takes a lot more time for people to save up enough money to be able to buy their first home. And that's when people buy a home, they start settling down, They start buying furniture, drapes, washing machines, whatever it is. But that age is going higher and higher and higher. And that is slowing down some of the demand for real estate also. The last week we had consumer confidence, which was up, which is a good sign. The real GDP second estimate was, again, we saw this earlier, it is down for Q1 to about 0.2%. Inflation rose 0.1 to 2.1% year over year. PCE, that's the personal consumption expenditures index. That is what the Fed looks at. And it's close to 2% now for the Fed margin. That's what they were looking at. All the numbers we're seeing right now, all the data coming out this week, ISM, a consensus was expecting around 48.9. We got 48.5 today, which was a little bit lower, a little bit softer than expected, and a little bit softer than the previous number. Construction spending also was expected to go up, but down. So we are starting to see some softness in the hard data. We are going to get factory orders tomorrow. We get car sales. We get ISM manufacturing index later on. And then the big number is non-farm payroll. That is the big number, expected to be 128K. We saw the number last month at 177. So that was higher than expected. So we'll see if we can contain, but that's a big slowdown from 250,000 jobs created that we were seeing over the last couple of years on average. So we'll see how soft the labor market gets and how demand falls off, if it does, due to tariffs, which is expected to come in the third and fourth quarter of this year. Looking at the technicals, we're above the 200-day moving average, which is 57.88. We're around 59.10 this morning. We made the third wave high. We saw a fourth wave pullback, kissed the 200-day right here, and then bounced off of it. And now fourth waves are messy. They go back and forth a little bit. But I am expecting the fifth wave to take us up towards this all-time high, which is around 6,100. Looking at this number right here, seems like we completed the fourth wave. This is the weekly. Each one of these vertical lines that you see right here are 1 week of trading, going back a number of years. So the fifth wave target is coming around somewhere 6,300 to 6,400, and we're around 5,900 today. So we could get up a little bit higher, but again, this is weeks and weeks of trading, so it could be later on this year or next year before we get to that number. We'll have to wait and see. NASDAQ also looks like it's completing a third wave, going down to the fourth wave. This is the 20-day moving average. The red line, the magenta line, is the 200-day, and this is the 50-day moving average right here. We're 19,171, which is pretty good overall. And as I mentioned last week, the big number is 18.3. That's the 20-day moving average and the 50-day moving average, very close to one another right here. We're at 19.1, so we're nicely above this. My dot plot, as you can see, the dots are down here, so they're way below the market, and the dot plot turned up about 4 weeks ago, and since then we've come up quite a bit. That turned up about 17.5, and once the dots are below the market, that's positive. Once they're above the market, as they had turned down at the beginning of this year, and they were down until about 4 weeks ago. So we're starting to see, once they turn up, you can see that the dots are below the market. They usually last for a long period of time. The market continues to go up for at least 6 months to a year. So that's a positive sign technically for the market. Interest rates right around 4.4 today, and just bouncing off the 20-day moving average, which is 4.43. 50 days 4.34, 200 day. As long as we stay somewhere around here, we're okay in this range. But if we start getting above here, that would be very negative for the market, and that's around 4.81, the high that we made at the beginning of the year, as the inflation number was expected to go up, but it didn't. Gold is starting to break out. We had this downtrend line, and we broke out above it today. Looks like we're headed towards the projection from third wave to the fifth wave high is right around here, around 3,800, between 36 and 38. So we could see quite a bit of run up in the gold market, and that looks like it's breaking out today to the upside, a big move to the upside today. Oil bouncing up today, came up to the 50-day moving average, came back down from there. So we're bouncing around. As long as we stay somewhere around here, looks like we're in the fourth wave. We can bounce around here for a period of time. Went up, went down, went up, and we can bounce around here. There are talks going on this weekend, or starting today, between Ukraine and Russia. I don't expect much to come out, but if there is a surprise and there's some kind of ceasefire between Russia and Ukraine, that could be very positive. Could bring crude oil prices further lower, and that could, because then I think sooner or later, if we do get a deal between Russia and Ukraine, we will take off some of the sanctions on Russia, and that'll bring Russian oil back to the market, which could increase supply quite a bit. Again, don't forget, those are my thoughts. Those are my the way I'm looking at the market this week. Again, if you need help with your portfolio, send us an email at invest@compact.com, or just call us at 800-388-9700. And don't forget to subscribe to this channel. Just click on the subscribe button so you'll get this update whenever I post one. Those are my thoughts. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors, because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.